All right, so now that we have made it through the introductory material, some accounting principles and assumptions, and we've made it through the entire accounting cycle, want to spend a little bit of time on how the accounting for merchandising businesses like Walmart and Amazon, so forth, how their financial statements will differ. And I just want to say that by far there are far more similarities than there are differences between a service-related business, similar to what we've looked at heretofore, and a merchandising business. But there are some differences, so we'll want to go over those. So let's see here. We've got some learning objectives, and most of the learning objectives, in a nutshell, deal with differences in the financial statements. We will look at, really for the most part, what we're going to be looking at is one major change with the income statement and one additional item on the balance sheet. Other than that, most everything else will be similar to what you've seen so far. So let's talk a little bit about the operating cycle. And by operating cycle, what we're talking about is just the process of making money for a business. So when we think about a service-related business, similar to the examples that we've had with Net Solutions, for example, step one is to provide a service, and generally service-related companies have a relative handful of services that they provide. If you call a plumber, they might be able to do any number of things for you, but by and large, they do 5 or 10 things most of the time. Step two is to either A, collect cash at the point of providing the service, or to recognize the revenue and to increase accounts receivable for services provided on credit. And then step three, if necessary, is to collect cash. So if we collect cash here, we don't even need step three. So this operating cycle for a service business is either 2 steps or 3 steps. So let's compare that with a merchandising business. So the first step is already more complicated. We're going to purchase some inventory. This is the first time we've seen inventory come into play. And we're either going to do that with cash, or we're going to buy that inventory on credit. So if we're buying it on credit, we're getting the inventory. That's going to end up being our asset, but we're also creating a liability. We call that accounts payable. Remember, anytime we see the word payable, it will always, always, always be a liability. Step two, market items for sale. Now, you could make the argument that a service business also markets their service, but a merchandising business tends to sell, for every one service that a service-related business offers, a merchandising business might offer, 5 items, 50 items, 500 items. So marketing is a lot bigger deal. There are some other steps in this that are not even listed, such as protecting inventory and so forth, but step three is we're going to make the sale. This would be similar to providing service, which is step one in the previous example. Step four, we're either going to collect cash or increase accounts receivable. Step five, which would be similar to step three, and for the service business, we're going to collect cash if we didn't already collect cash. And then number six, if necessary, from step one, we're going to pay the payable. So on step six, if we didn't pay with cash up here, at some point, very quickly, we're going to have to take care of this liability that we have incurred. Merchandising businesses are further complicated by the operating cycle length. So when we think about service-related businesses, we do have some service-related businesses. Construction, for example, would be one where we have a really, really long time between the beginning part of a service and the end of that service. But look at this example here. Over here we have what looks to be the produce section of a grocery store. And then over here we have some jewelry, watches and so forth. And so what we want to understand is that this grocery store, when they buy this cabbage or whatever, these peppers here, they understand that these items are not going to be sellable for very long. So they're dealing with a very, very short operating cycle from the time they purchase that inventory to the time that they sell it. And there's also more of a simplicity here. They're almost certainly not going to have to deal with accounts receivable. Over here with jewelry, these are more expensive items, so the operating cycle is going to be longer and also probably more complicated in that we're going to have a greater mix between cash sales and sales made on credit. Okay. So, financial statements, we said that there would be some differences between the two, and this does not actually say that this is an income statement, but that's essentially what it is. So if we see over here, it says service business and then merchandise business. The terminology here between fees earned and sales, this is essentially a similarity, not really a difference. We could just as easily say service revenue here and sales revenue over here, and they would be basically the same. Now, what we are going to introduce here are a couple of things. These two items right here, cost of goods sold. This is an expense account, and this represents the cost of whatever inventory it is that we have sold. So we don't have any inventory over here, so we don't have that. And so when we subtract the cost of that inventory from the sales, and there's a couple of other things that we have to account for, but this is a bare bones approach here, we come up with this thing called gross profit. Okay, and gross profit is just the difference between what we paid for the items and then what we sold it for. This number will almost always be a positive number. If it isn't, we're in a lot of trouble. Then we have operating expenses for the service business and for the merchandising business, and these are essentially identical. The biggest one would be salary and wage expense, but both of these businesses are going to have utilities, all of those kinds of things, right? And then ultimately we get down to the bottom and we have what we're referring to as operating income. Operating income is not the exact same as net income, because sometimes we have some items we're going to discuss later in the course that will contribute to net income, but the difference between net income or net loss is the full and final total of how much money we made or lost in the period. When we talk about operating income, okay, we're talking about how much money have we made or lost in the period from our normal operations, right? So sometimes in business, we might buy a piece of machinery and figure, and as soon as we buy it, something much better comes along and we have no choice but to get rid of that piece of equipment that we just bought, and we sell it for a tremendous loss. And so that loss could impact net income, right? But it would have no impact on operating income because it's something that's not going to happen very often. So that's the difference between those two terms, in case you were wondering, and hopefully you were. All right, what else do we have here? All right, so I want to go back to this slide. We have this cost of goods sold here, and I said that it was essentially the difference between what we pay for an item and what we sell for it, or sell the item for, but it becomes a little bit more complex. So we have this little formula here. We take our beginning inventory and we add to it our purchases, and then we subtract out ending inventory, and that's going to give us our cost of goods sold. And so if we think about this for a moment, let's just say that our beginning inventory here was $10,000. Okay, that was our beginning inventory. And then we're going to add to that our purchases that we made throughout the year, which might be something like $100,000. And then at the end of the year, we're going to count our inventory and figure out what the value of that is. And let's just say that it was 20,000. Well, if we execute this, I'm going to abbreviate here because I'm running out of room. 90K, 90,000. 10,000 plus 100,000 minus 20,000 is 90,000. So what this means is that of this 100,000 that we bought, you know, we still have, we didn't really sell. We bought more than what we really needed to buy. See, because our ending inventory was greater than our beginning inventory. So the cost of the items actually sold are 90,000 because we still have 20,000 of that inventory. So this is the cost of goods sold formula. Our beginning inventory here, plus our purchases throughout the year here, minus what we have at the end of the period. Okay? All right, let's see what else we have here. Okay, I think what we're going to do is we're going to go ahead and cut this video or close this video out, and we're going to pick up with some additional topics so that we don't make this video too long just after this.